The AI hype is really putting a lot of interest into the utility space. It's expected that data centers are going to consume a lot of power. I don't doubt that. I think that data centers consume a lot of power. And if there's incremental amount of high performance computing for the AI space, they're going to need more power. But it might be getting out of hand. Vistra Corporation is an independent power producer, and its stock is up 249% in 1 year. Utility companies historically have been a sector, an industry that I just stayed away from. I just don't like that they have to put so much capital back into their businesses. It seems that every 2, 3, 4 years, they have to literally rebuy all the equipment that they run. They're also regulated in many areas, especially around residential. So there's just a lot of undesirables that I don't like about the space. So I haven't been a big investor in utilities. But the really big rise in this particular stock, as well as other stocks of power producers, really caught my attention. This is an obvious, real run up of stocks in preparation for what might happen, which is AI is going to be big. And the problem with the stock going up so fast right now is that it's going to take a while for the AI space to really become something. Just think about how long it took Waymo, which is a Google company that does autonomous driving. They've been around for more than 15 years and they still aren't mainstream. That's the type of car that AI is going to drive around and get people from point A to point B. So it's taken about 15 years for it to become closer to reality in most cities. Right now, it's very limited in just a few cities. Other big ideas in AI are going to take a long time. And all of that is therefore going to have a long-term demand curve for utility companies. So when a utility stock like Vistra goes up 249% in 1 year, to me, it's an obvious opportunity to look at a stock and potentially short this stock, because a couple of things I see are going to prevent this stock from really growing their revenues. First, you just can't build a power plant overnight. It takes 5, 10 years to decide where you're going to build a power plant. Then you got to go raise the capital. You need to get a lot of red tape and regulation handled. When you finally get that power plant into service is 5, 10 years later. So for a stock to jump up 250% in 1 year, I just really doubt that they're going to be able to create more revenue very quickly. So I'm going to take a look at this stock, really dissect the fundamentals, and see what this company naturally would be valued at, in my opinion, and compare it to the current stock price. Keep in mind, I'm an independent investor. I don't recommend you buy or sell Vistra stock. I don't recommend you short it. I don't recommend you do any investing in this stock at all. Make your own decisions, make your own investing actions. I'm not providing any financial advice. I'm also being sponsored by Moomoo, which is a brokerage, and I appreciate their sponsorship. They offer new account holders, if you deposit more than $1,000, they offer 15 free stocks. They'll also pay you 8.1% on cash for the first 3 months, which is pretty attractive. Take a look at the details of the video if you're interested in that offer. So back to Vistra. So Vistra is a independent power company, and they were humming along. If we look at the 5-year chart, the stock was pretty much bumping along at around $20 per share. And then the AI hype happened. In the middle of 2023, this stock just took off and it's up 250%. Now, I'm always in favor of a company being rewarded when they have a great product or they have a great solution, and it's expected that their company is going to grow their revenue. But this one here is really suspect, because when I look at the current PE ratio is 56 for a utility. If you look at historical PE ratios for utilities, they should be around 12. The forward PE is around 24. It's still very high. They pay now a small dividend of 0.94%. Utility companies typically pay a high dividend. That's how they attract investors. In this case here, they're paying a really low dividend rate because the stock price has gone up so much. Investors can't, say enough good things about utilities, but there's a lot of analysts that cover Vistra and they say it's a strong buy, but they at the same time say it's overpriced by 4.85%, which is interesting. When we look at their financials, there's one thing that I would point out that's a big concern. If we look at their revenue and look at their quarterly revenue, the most recently closed quarter, the revenue went down by 30.98%. That's a big drop in revenue. In the previous quarter, it dropped 20%. In the previous quarter, 20%. So I'm not quite sure why their revenue is dropping. I mean, this is energy; it's in demand. Not sure, what's going on with the revenue line. I did take a look at their earnings, and I see that they are operating as usual, but it's probably the rates they're getting are not as attractive in the current period. So that's one red flag that I would point out is if they're up 250% their stock, why isn't their revenue growing? The revenue is not growing. It's actually contracting. They went for the most previously closed quarter. They closed with about $3 billion of revenue. If you can compare it to a year prior, they were above $4 billion in revenue. So where did that revenue go? That's interesting and concerning. The company was not profitable in the most recent quarter, which is also a concern. And the free cash flow for the company, that is one of the metrics that I use. It actually went negative in the most recent quarter. That's a big concern. Utility companies, in my experience, seldom produce free cash flow. And the reason for it is capital expense. They have to put in so much capital expense into their power plants that it just erodes all the free cash. Free cash is cash from operations minus capital expenditures. And typically, utility companies have so much CapEx that they run a negative free cash flow rate. And to me, that's usually a deal stopper. I'm not interested in a company like that. In this case here, for the most recent quarter, this company did have negative free cash. For the trailing 12 months, this company does have, with regards to free cash flow, positive free cash flow of 2.9 billion. So that's good, but I want to keep an eye on free cash flow. If we look at historically, in 2022, they had negative free cash flow. And in 2021, they had negative free cash flow again. So that is somewhat normal of a utility company having negative free cash. More recently, they've had positive free cash. So we'll see how that sorts itself out. But again, another concern is the most recent quarter, they have negative free cash. So the company revenues are going down. Most recent quarter, negative free cash. With regards to the balance sheet, they have a little over $1 billion of cash on the balance sheet, which is good. But they have over $16 billion of debt. And their debt has been rising. It went up 31.7% in the trailing 12 months. That's a concern. If you keep accumulating debt, that just becomes a big issue. So that's red flag number 3. So I've got some red flags on their fundamentals that I'm going to look at closely when I analyze the company using free cash flows and earnings per share. When I look at the forecast for the company, 6 analysts cover this company, and the 6 analysts have an average price target of $87, but the stock is trading above $87 to the point where it's sold at a premium of 4.85%. And that is a concern. When we look at their earnings per share, it's expected to be $5.10 for the current year, 2024. And there is good growth rate expected. And their revenue, which doesn't align very well with their actuals, it's expected to grow somewhat, the forecast that analysts have. But if you look at their financials, their forecast is inaccurate. The last 3 quarters, their revenue has gone down. So I'm not quite sure where these analysts are getting their numbers, but their actual numbers don't look good. The last 3 quarters, their revenue has been going down. So overall, the earnings per share, I will use the $5.10. I will use a valuation that's optimistic for this company. And let me see what kind of value I get from my model using free cash flow as well as earnings per share. So I'm going to value Vistra using free cash flows and earnings per share. First, free cash flows. The company has $2.2 billion of free cash if you look at their trailing 12 months, and they're guiding for them to produce that type of free cash. So I'll go ahead and use that. Even though their most recent quarter is in the negative, I'm going to give them the benefit of the doubt, and I'm going to use $2.2 billion as a starting point. I'm going to be very optimistic and say that those free cash flows are going to grow by 2% in years 2, 3, and 4, and then long term, they're going to grow at 3%. That would not be typical to a utility company, but I'm going to give them the benefit of the doubt. I'm going to pretend that this is a utility that's going to buck the trend in the industry and really produce positive free cash flows over the next 4 years, as well as all years after year 4. Now, this is a riskier investment, so I'm going to use a discount rate of 10% because this company has higher debt. We're in an interesting point with AI. It may work. It may not. It may become a very big industry and ecosystem. It may not. And if it doesn't, boy, there's going to be a lot of disappointed stockholders. So I'm using a 10% discount rate. When I discount all those free cash flows, that is a very optimistic forecast, I get $28.499 billion of value. I'm going to add the cash on the balance sheet, but take away debt, which is pretty high at $16.6 billion. And it reduces equity value of this company. It reduces it down to $12.9 billion. The market cap of the company is way up there, $32 billion. So really, there's about a 60% premium if you value the company using free cash flows on a very optimistic forecast compared to the current stock price. You could see that 250% rise in the stock price has really made the valuation, really turned it upside down. Looking at the earnings per share, it's quite optimistic that they're going to have an earnings per share of 5.1, $5.10. I'm willing to go with that. I'm going to go with a PE of 12, which is the typical utility PE. I get that AI is exciting, but this is a utility. And I'm going to go with the normal PE ratio on a utility company. It needs a growth rate of 10%. We started with an optimistic earnings per share of $5.10, and I'm going to be optimistic and say they're going to grow that at 10%. So it gives me a stock value of $67.32, which is well below the current stock price of $92.72. So it's overpriced by 27% if I value the company using earnings per share. When I combine the two and I put more weight in free cash flow, I get this valuation. The stock is priced at a premium of 49%. That's a pretty steep premium, but it kind of makes sense. The stock's up 250%. So right now, this valuation is underwater. So what's the opportunity for me with Vistra? I don't currently own any shares. So really, the two decisions for me are either buy shares and expect that the shares are going to go up in value, or short the shares if I think it's grossly overvalued, and I'd probably make more money shorting the stock and waiting for the stock to drop. Well, let me look at three main areas that I look at in every investment. First, I look at the company and I want to know, is this a strong company? Do they have competitive moats, competitive advantages to keep competitors out of their market? Is this a company in an industry that I want to be a part of? And the answer is no for Vistra. Utility companies, it's electricity, it's energy, and building these power plants costs a lot of money. I would give them that there is a barrier of entry, which is you have to A, put up a lot of capital, and two, go through a lot of red tape and regulation to build your power plant to begin with. But that's not a big competitive moat. What if solar becomes just far better, or a couple of nuclear power plants in your areas of business get started and they start selling power at a lower rate than you have? Those can be threats to a business like Vistra. So overall, from a company perspective, I'm not a buyer into this company or this industry. Second area is the balance sheet. Do I like the balance sheet? Do I think the balance sheet's in good shape? And the answer is no. If you look at debt to EBITDA, you're looking at EBITDA that is going to be probably between $2 and $3 billion. At that rate, they would be between 6 to 8 if you look at debt to EBITDA ratios. That's well above my 3. So it's a risky balance sheet, in my opinion. And the debt has continued to rise year after year. So I don't like the balance sheet. The discount, well, it's being priced based on my analysis at a 49% discount premium. So I hate the discount because it is a premium that you'd have to pay for this utility company. Having said that, this is a perfect negative score. I do not like the company. I do not like the balance sheet, and I do not like the discount. Therefore, I'm going to short these shares. It's not going to be a big position, but I'm going to begin to dollar cost average a short position in Vistra. We'll see where this goes. I think that this stock is going to settle down. I think AI stocks are overhyped. I believe in the AI space. I think it's really exciting, but I think stock prices have gotten way too high in this area. There are a few businesses that are beginning to operate that are showing promise. For example, ChatGPT is beginning to charge for their premium AI service. So is Google with their Gemini service. They provide Gemini for free, but they also charge for a more premium service. Then you have Microsoft that's providing a Copilot on all their Office products, and they're going to charge for that. That looks promising, but it's nowhere near, those revenues are nowhere near the investment that's currently happening in the AI space. It is really, really excessive, the amount of investment. It's really getting built out, and I think it's going to take a while for these businesses to really be real. So between now and then, I think at some point we're going to have a real big correction in a lot of these stocks, including the utility stocks that right now are being really fueled with a lot of hype, and the revenues are not going to go up very fast. So investors will get frustrated, and I think this stock will drop over time. So that's just my opinion. Again, I don't recommend that you buy, hold, sell, short this stock. I'm just sharing my experience and my opinion on this stock. I also have nothing bad to say about this company. This is a good company. I just don't believe that the stock price is always aligned with the business. In this case here, I think it's misaligned. the first suspicion is when a stock rises 250%, it immediately catches the attention of everyone, including myself. And when I analyze the company, I see that the stock price is misaligned with the company. So that's my analysis on Vistra. I hope you found it interesting, and I appreciate you watching.